Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. So, what's been happening in the markets lately, right? We've got past data. If we look at non-farm payrolls, the wages number come in higher. We had recently Friday the PPI, Producer Price Index, come in higher as well. Although we're seeing oil prices drop to new lows and continue to fall. And also, we've seen consumer confidence come in strong. And now we have consumer price index, CPI, another inflation metric coming out tomorrow. So markets are really going to move on this tomorrow. It's going to be very, very important to watch what CPI comes out when you're comparing against the expected. And definitely a lot of traders, a lot of investors, Fed economists, Fed members, everybody's going to be watching this, the government as well. It's going to be a very highly anticipated report because last CPI that we got came in lower than expected. So we want to see tomorrow, are we going to see lower than expected CPI or higher than expected, right? It will be very interesting to see that whether this number is coming in lower, and if it does, it might start to signal to the markets and to others that hey, inflation has peaked. We're starting to see the signs of tightening, the signs of higher interest rates start to affect the prices, start to affect CPI, inflation, and this is probably a good, no, not probably, but well, I could say many things about whether this is a good thing or not, but from the market's context and for what it means for tomorrow, the equities and bonds could rally if the number comes in weak. And we could see a very strong day in the equity markets, 3 to 4% rise, especially if the report comes in very weak. So it's going to be quite crucial to see what that number comes out. Comes out 8:30 a.m. tomorrow. And what you want to pay attention to most importantly is the core number, right? The core number doesn't include the energy prices, which are volatile numbers, right? The headline number itself, you could expect that, yeah, maybe we might see that number come down lower, especially as oil prices are falling. Now, again, this report looks at last month's data. So, will we see the reflection of the data or the oil prices that we're seeing today in this report? We'll see what happens tomorrow when we take a look at headline and core. But definitely core does matter. You do want to look at the core number, and we'll see what that number comes out as. Now, what does this mean for the Fed? What does this mean for the FOMC if inflation does come out lower, right? Because next day you do have the Fed coming out. And basically they're going to release their projections where they see interest rates heading, the projections of growth data, GDP, and etc. They have their meeting as well, so we've got the minutes and then the meeting that they're going to have around 2:30 on Wednesday, and we'll hear the Q&A. We'll hear more about what the Fed is planning to do, especially next year. Very important. Are we going to see higher rates or not? So the expectation is that they're going to slow down with interest rates. They're going to raise rates Wednesday, by 50 basis points. So that's the expectation. And then definitely tomorrow, CPI may also start to give a bias towards how the meeting may be for Wednesday. And if CPI is weak, Fed can come out and say that, hey, we don't need to tighten as much because the data is lagging, and we have to take into consideration the lag effect from doing all this tightening. We'll probably see that play into next year, and we'll see that in the data, we'll see that in the prices, and then we will be able to make a decision whether we should stop raising rates or not. But they haven't mentioned about pausing rates. That's the key. The key is they haven't mentioned about pausing rates. Yes, they've said that they're going to slow down the rates. They're not going to raise rates as aggressively to 50 or 75, but they're going to basically slow down the pace, maybe do 25 basis points, but still continue to raise rates, continue to move up that terminal rate, because they still need hard evidence and more data, more information that yes, this CPI, this inflation is coming down. If they act too early and pause too early or start cutting rates, it could be the same scenario back in 1980s where they have to go another round of hiking rates aggressively, and we heard that the Fed doesn't want to do that. Another thing is that they're continuing to raise the rates, and they said that they're going to leave rates at high elevated levels for quite some time. And that has to do with the average inflation target long ago, or actually not long ago, but back in 2020 when they introduced it. I think everybody has forgotten about this AIT average inflation target, where they want to keep rates elevated so that the average inflation number, when it's coming down, the average can basically hit 2%, which is their target. Now, to hit 2%, you probably want to see the number, or that average, or to get the average of 2%, you probably want to see some inflation prints go below 2%. And how do you get to that? Well, very ugly data, recession, severe recession, etc., etc. Right? Now, what happens if CPI comes in strong tomorrow? What if it's very strong? It's a big shock, right? Then that will start to play into Wednesday's meeting that, hey, they may still go with the 50 basis point rate hike, but come out and say that, hey, we're probably not going to do 25 basis point in January. We're going to go with the 50 and then maybe another 50 again because, hey, look, CPI inflation is not getting better, right? Maybe shelter or wages, it's still not getting better. Services components still not getting better. So sure, yes, that could be another scenario too. But again, we will find out more. We'll see what happens tomorrow in CPI's report. And when it comes out, I'll probably do a video on it and then another one on the FOMC meeting. We'll also talk about that and see what happens there and what the Fed has said. So pretty interesting, interesting week that we've got. And we got some other data also closer to the end of the week as well. And then you got 2 weeks left of the year, and we'll see where markets head to after getting these two very important, crucial data and information. Now, another thing I want to note, maybe I'll do a separate video on this, but Bank of Canada, Macklem, right? The head of Bank of Canada, his name is Macklem. He came out also today and basically said that, hey, we still want to fight inflation. We've seen some signs of it coming down, but still elevated. We still want to reach to our 2% target. However, it could look like that we may not reach that 2% target for a long time. And he mentioned that even if we do get to our 2% target, long term, we may not see 2% as hinting towards maybe that may not be the norm, especially because of how the supply chain has been disrupted, how there is this tension between the West and the East, tension between China and the US and the other Western countries as well, that has completely disrupted the supply chain. And if that continues to be a problem and supply chain continues to be an issue and resources continue to be an issue, then sure, longer term, we could see a very different era. And that's what Macklem basically said, that the disinflationary era that we had kind of 2 decades ago, we're probably not going to see that anymore. And we could be in a new norm. Now, he didn't say that explicitly the way I'm explaining it, but he hinted towards that by saying that that disinflationary period that we had, we may not see it ever come back, or if we do ever get back to it, it's going to take a very long time because of how much supply chain has been disrupted. So why I mentioned that to you is it'll be very interesting to see if Jerome Powell on Wednesday say something along those lines as well. He may not, right? But it will be very interesting to keep a note of that and pick that up and keep that at the back of our heads and our minds, because if he does say that, and you're starting to see central banks move towards this theme that, hey, we're probably not going to hit 2%, that is the equivalent of basically changing the goalpost, right? Your goalpost was 2%, and saying that, hey, we need to hit this. Be like, you know what? We basically can't do it. So in other words, we failed. Let's move the goalpost to maybe 3% and or 3 or 4%, which Macklem was hinting towards. So let's see if the Fed also goes towards that, hints towards that. That will be very, very interesting, and that could also be very positive for the equity market as well, because maybe maybe you'll see that the 3% norm basically be that thing where we'll never see 2%, and equities will basically rally and like that, because that means that even if we do tighten, we're going to eventually pause. And if we pause at 3%, that means the pause is coming sooner, because we don't have to hit that 2%. And then the other question I would have is, what about the AIT? So do we now say the new AIT or the average is around the 3%? Again, it's still positive for equities, because you're not hard on this 2% rule. But it's a shot in the dark. We'll see what happens on Wednesday, whether this theme continues to be a theme around all central banks. But it's very interesting to note that Bank of Canada said something about this theme of inflation not hitting 2%, this disinflationary period that we saw 2 decades ago, probably never going to come, just because of the supply chain issues. All right. So anyways, leave a comment below, subscribe, hit the like button, and the bell icon to be notified on the next video. Let me know what you guys think about CPI and inflation in the next report, and the Fed, what they plan to do, and I'll see you guys around. Cheers.